Good morning, folks. It's 9 o'clock. Let's get cracking. Welcome to today's webinar. As you can see from the slide, today we're going to just look at a bit of legislation. It's probably only going to be about 40 minutes long, the webinar, but today we're going to look at travel allowances, the company car fringe benefit, and subsistence allowances. I'm going to try and make it as practical as I can. Quite a few of the issues are issues that I regularly get queries on, and a lot of the issues are really misunderstood by companies. I'm going to talk about good practice, and I'm going to give you a couple of scenarios to show you what you must and must not do when dealing with an employee regarding any of these issues. We often see employers get pushed into a corner in terms of making decisions that are not best practice and are not good for the company. What I'll also do is I'll do questions at the end, if you don't mind, and if you want the video, just drop us a line and we will send it through to you. I'm going to start with travel allowances. Sorry, having an internet issue, so the line is quite slow. Okay, so travel allowances. Should a travel allowance be allocated to employees who are, as a condition of employment, not specify that the employee is entitled to such an allowance. I know that's nitpicking, but you don't want to be in that position. So it's quite important that you have a decent clause in your employment contract and in the offer of employment saying that the employee is entitled to a travel allowance as a condition of employment. They are required to travel regularly for business purposes. How do you determine what the travel allowance is going to be? Okay, so just very, very briefly, travel allowance is granted to finance the employee's business travel cost, not total travel cost. I've got many clients who get pushed into a corner by the employees who tell them, look, I can't finance a car for 7,500 Rand. 7,500 Rand doesn't finance my car, pay for my petrol, insurance, maintenance, etc. The logic is fundamentally flawed because you as the company are not there to finance the employee's car. The employee, as a condition of employment, has to have a car, and the employer is giving them a portion of the cost of maintaining that car to undertake business travel. So I'm going to give you some tools a little bit later to help you determine this travel allowance. So as I said earlier, don't get pushed into a corner. Don't let the emotional outbursts of employees push you into giving more money than the employee should be getting. You are not there to finance his total vehicle, including private travel. Third bullet point, a fixed travel allowance should only be issued to employees who are required to do substantial business travel. SARS take a dim view of companies giving travel allowances to employees who are required to do very little, / sundry business travel. It's quite important that management identify the employees who are required to do substantial business travel and give them a travel allowance. And then we'll discuss a little bit later reimbursement travel allowances. Those employees that do minimal business travel should be on a reimbursement travel system. The reason why I'm saying this, fixed travel allowance gives the employee a certain cash flow benefit because only 80 or 20% of their travel allowance is taxed monthly. And obviously SARS are losing out on tax, and they do not want a situation where you give the employee a travel allowance and the potential to commit fraud by padding a logbook with bogus business travel. It is recommended that companies assess travel allowances on an annual basis to ensure that that travel allowance is appropriate for the individual. Now, don't get confused by an increment increase. What we are saying here is the travel allowance travel. If their situation changes significantly, they go from, for example, client liaison to a full rep position, and their business travels doubles, as an example. It would be appropriate to obviously give them more money because they're expected to undertake more business travel. So SARS would require you to do that, and any level-headed, sensible employee would also require the employer to apply their minds there. The value of the travel allowance must be calculated according to the cost of the employee's vehicle and the business and they do. Far too often I see in industry some sort of a thumbsuck value. There is a tool available for you to do the actual calculation, and it makes sense to utilize that. It would also prevent you as the employer potentially paying over the odds to the employee. Now, an example of how to arrive at this travel allowance, as I said, we need to factor in the cost of the vehicle, the total annual mileage undertaken, and the total annual business mileage undertaken. Let's look at the next two slides. You should all have seen this table, the slide before. Just to give you a little bit of background, for those of you who submit tax returns with a travel allowance and you don't put in actual mileage, this table is built into the SARS assessment system. And obviously on your tax return, you would put an opening and closing mileage to work out the total business mileage, the total mileage undertaken. You would put in your business mileage that tied up to a logbook, and you would obviously put in the cost of the vehicle. Now, as you can see on the left-hand axis, you've got values. So 0 to 95,000 is the cost of the vehicle, including VAT. Values going down the left side. Each bracket has got a fixed cost element, a fuel information, establish what your travel deduction is. Now that deduction will be offset against the travel allowance that you receive, and will dictate how much your refund is. So just to look at a scenario, if I received a travel allowance of 100,000 for a year, and my travel deduction works out to be, made sure that 100,000 of my remuneration on assessment is tax-free. Now, if my employer had taxed 80% of that travel allowance for the year, that would mean that I would be getting my tax back on 80,000 Rand. A nice refund, and not to be sneezed at. Obviously, if your travel deduction is only 50,000, then you're going to get obviously that portion of the previously taxed travel allowance back. If your deduction is more than 100,000, unfortunately, SARS limit the deduction to the actual travel allowance. So if you do this calculation that I'm going to show you on the next slide, you'll be in a good position to get all the tax back on your travel allowance. Okay, so what we've done here is a calculation that I do regularly for our clients. And what I'm going to do is I'm going to work out the optimal travel allowance for a person in this specific situation. So let's just look at an example. In this case, the employee's got a car costing 250,000. If we go to the previous slide, we'll look where 250,000 falls into that bracket. And as you'll see, it's the third bracket. And we will use those figures. E is the fixed cost for a car of 250,000 is 75,039 Rand. We divide that by the total mileage that the employee is expected to do in the year, which in this case is 32,105, to get a fixed rate per kilometer. So in this case, the 75,039 Rand divided by 32,105 Rand gives you a fixed rate per kilometer of 2 Rand 33.7 cents. Okay. I like to use 3 decimal points here because obviously the table provides 3 decimal points. Now what you do is you add the fuel cost per kilometer and the maintenance cost per kilometer as per the previous table to arrive at a total cost per kilometer. So in this case, on the right-hand column, you can see that I've added the fixed cost, the fuel, and the maintenance element in that bracket to at that figure. And in this example, the 18,000 by the 4 Rand 13 and 2 cents, like 65 Rand and 71 cents. The travel deduction that you would be entitled to for the whole year. Divide that by 12, and you can quite comfortably give the employee a travel allowance of 6,313 Rand and 81 cents per month, knowing that if they do the mileage that they expect to do and their business mileage is what they expect to do, they would get the tax back on that. Now, obviously, this is quite a scientific approach. People will ask me, what happens if the employee doesn't do that mileage? You need to remember that only 80%, generally 80% of a travel allowance is taxed. So it does build in some sort of area for error here. Okay, so it's not cast in stone, this figure, but you know that if the employee supplies those facts on their tax return, they're going to be okay. If you've got any questions on that calculation, you're welcome to ask me that. Of employee using the car for business purposes. You might have used one of your parents' names, or you might have used your spouse's name. So the person who owns the vehicle is pretty irrelevant here. What is important is that vehicle must have been used by you in the performance of your duties. for that vehicle. So it's important that you provide that, but the reason that they're asking for the basis of the calculation for the travel deduction. So the vehicle can be owned by someone, but it's important, don't get caught out by putting together a fraudulent logbook. And SARS are not that stupid. They've got systems in place to identify, is this vehicle being used by someone else? So there are scenarios where people put together a logbook for a vehicle, and it turns out that their uncle or their father is using the same vehicle for a logbook claim. You cannot receive a travel allowance for a vehicle that is owned by your employer. That obviously makes sense because that would then be a company car. Having use of a company-owned petrol card or being reimbursed for petrol expenses is treated the same way for employees' tax as a fixed monthly travel allowance. So what a lot of employers forget is that if they're providing that petrol card, every month the value spent on that petrol card to the fixed travel allowance and taxed as a travel card. Quite a gray area. What qualifies for travel allowances? For travel mileage. Traveling from your home to work is always regarded as private. Traveling from your home to see a client is regarded as business. Traveling from your business to a client is obviously business. So be consistent and be careful, because SARS will be looking at that. Okay, so the last point on this slide: employees in receipt of a travel allowance are required to complete an annual tax return wherein they justify their business travel incurred. If you don't submit figures on a tax return, you're going to owe money. Why? Because remember, only 80% of the travel allowance is taxed on a monthly basis. If you don't submit travel figures, SARS are going to tax the other 20%, and you're going to owe money on assessment. Same applies for the use of code 3702, which I'm going to explain later. If your employer is only reimbursing you at a per kilometer rate, and that is above the SARS rate, you still need to submit a logbook on assessment. I have probably 50 to 60 a year of our clients coming saying, you haven't taxed me correctly in payroll, this is wrong. And then I look, and it's the employee has not put in a travel claim on their tax return. Travel allowances must not be disproportionate to the other package components received by the employee. Now what I'm saying there is, if you're earning 25,000 Rand a month as a salary, it would be disproportionate to give you a 35,000 Rand travel allowance. SARS would ask in that situation, is the employee working for a travel allowance? And 9 times out of 10, their attitude would be that you've structured that salary too aggressively, and that the travel allowance hasn't actually been given to enable the employee to travel. It's just been given to save tax. So as a golden rule, I always prefer that a travel allowance shouldn't be more than 35% of the employee's gross cash pay. So in other words, if there's 30,000 cash pay, a 10, 12,000 Rand travel allowance is fine. But more than that, it looks too aggressively structured, and you're going to get challenged. Now, as I've mentioned, the 80% and the 20% tax travel allowance before, but I just want to clarify here. The employer has got a decision to make. If the employer thinks that the employee is going to travel less than 80% for business purposes, they have to tax the travel allowance at 80%. Now, this is the default position that I encourage employers to go with. When in doubt, tax 80%. If the employee is going to travel more than 80% for business purposes, so your rep who is on the road the whole day, and you know that he doesn't live too far from the office, so his private mileage is going to be minimal, then you can tax 20%. And the logic of that is it's unfair to overtax that individual, because he's going to get the majority of that tax back on assessment. He's going to have to wait more than a year for that tax. So SARS a while back changed the legislation to say if the company's confident that the employee is going to travel more than 80% for business purposes, you only need to tax 20%. Now, in the parallel environments, we've had situations in the past where employers have wanted to tax 100% of the travel allowance. I'm not sure why they would do that. To me, that's showing that they're not confident that they've applied the legislation correctly. But that 100% is no longer permitted. The SARS BRS that they issue is basically the document that describes all the codes and what their practices, has done away with the 100% inclusion. So payroll systems now can only include 80 or 20% of the travel allowance. I mentioned travel reimbursements earlier, but important to note, the travel reimbursement is an alternative to a fixed monthly travel allowance. And when we talk travel reimbursement, we talk about a per kilometer reimbursement for business travel in a private vehicle. So the travel reimbursement payments is based on the actual business kilometers traveled. So in other words, the employee would be required to maintain a logbook and supply that logbook to his employer or her employer on a monthly basis. And then the employer has an opportunity to pay that person on a per kilometer basis for such travel. Now, the situation is a little bit more complicated than that, in that SARS publish an annual per kilometer rate at which they, a deemed travel rate that they say, if the employer goes at that rate or lower, then the reimbursement is tax-free and the payment is coded to code 3703. So it's tax-free in the month, it's tax-free on assessment. The employee need not supply any documentation to SARS when they do their tax return. The logbook that they supply their employer on a monthly basis is effectively the authorization for the payment of the R3.82 per kilometer tax-free. Now, the legislation fundamentally changed on 1 March 2018, which was the beginning of the 2019 tax year, to cater for a scenario where the employee may be reimbursed at a higher rate, okay? Whereas prior to 1 March 2018, if you were reimbursed at a higher rate, it was tax-free on a monthly basis still, but your employer had to use code 3702. Now, as I mentioned earlier, what's happened is when there's a 3702, your employee has to still submit a travel logbook and supply details on their tax return, okay? Because on assessment, SARS taxed that whole amount in code 3702. So it's important, once again, that the employee matches, in terms of a deduction, what they've received in code 3702 to make that amount remain tax-free. Now, as I've said to you, if you do your homework correctly, you know that on assessment, based on the value of the car, the total mileage and the reimbursement rate, that you're going to get a deduction equal to your total reimbursement. It's going to remain tax-free. But if your deduction is less than the amount in Code 3702, you're going to owe SARS money. And that's where the unhappiness starts. And that's where the finger pointing starts. And the finger pointing normally comes back to us as a payroll service provider. The employer does not tell the employee that they're being reimbursed at a higher rate than SARS rate, and that there will be a reporting requirement. Another change that happened on the 1st of March 2018 was SARS did away with the maximum reimbursement rates that would be tax-free. It changed from 8 to 12,000, 18,000 over the years. It's gone now. There's no minimum, there's no maximum, business kilometers that can be reimbursed. SARS say you can reimburse as many business kilometers as the employee does. And obviously they prefer that you do it at the R3.82 a kilometer. Another change as of the 1st of March 2018 was the inclusion of this new IP5 code, 3722. And the 3722 was factored in where the rate per kilometer reimbursed exceeded the prescribed SARS rate. So, for example, if you paid R4 per kilometer, the amount that would go into code 3722 would be R4 less R3.82. Okay. Obviously, code 3722 is linked to code 3702, which is your reimbursement code exceeding the SARS rate. So you'll see there in my section where I've said it must be noted, it's important that you know the difference between code 3722 and 3702. Remember, code 3722 is the business kilometers times by the rate per kilometer the employer pays minus the prescribed rate that SARS publishes. So it's the RAND value in excess of the SARS rate that goes into 3722, and that is taxed. Okay. Code 3722 may not be used without code 3702. Now, the amount that goes into 3702 is going to be the business kilometers reimbursed, okay, times by the SARS rate. So you've got the two codes, they're linked. The one is reporting business kilometers times the SARS rate, and the other is reporting the excess that you've been reimbursed over the SARS rate. Okay. Now, what I've done is I've done a table. Okay, I'm going to shoot through it quickly, but you can have a look at this in your own time. In the first case, or in all the cases, the employee's done 20,000 kilometers per annum for business. And then you'll see that the second column has got the reimbursement rate. Third column has got the total reimbursement value. And then in a couple of the scenarios, the employee gets reimbursed in addition to receiving a fixed travel allowance. So I'm going to shoot through very quickly the scenarios. In the first scenario, you've got a reimbursement rate of R2.61. So the first thing to note is that higher or lower than the SARS rate. Okay, it's lower. So if it's lower, the employee can be reimbursed tax-free. So if you apply the 20,000 times R2.61, you'll get 52,200. And as you'll see, that is coded to code 3703. It's tax-free in the month, and it's tax-free on assessment. Your employee has got no problems. Second scenario, the employee gets reimbursed R3.82 per kilometer. Same situation. Is that higher or lower than the SARS rates prescribed annually? It's exactly equal to. So in this case, the employee gets 76,400 Rand, and that is also goes to code 3702, tax-free in the month, tax-free on assessment. Third scenario, you'll notice straight away that the employee is being reimbursed at above the SARS rate. Okay, so he's being reimbursed 92,000 Rand 200 because he's getting 20,000 kilometers at 4 Rand 61. So as I said to you, the amount at the SARS rate, so 20,000 times 3 Rand 82 has to be reported in code 3702, which is 76,400. And then the balance that is being reimbursed over the SARS rate has to go to code 3722, which is the 15,800. So the 15,800, the amount that exceeds the SARS rate, is going to be taxed in that month. Fourth scenario, important to note, two things straight away. The employee is getting reimbursed less than the SARS rate, 2 Rand 61, but now he's getting a fixed travel allowance. Okay, where an employee gets a fixed travel allowance and reimbursed, the reimbursement cannot go into code 3703, okay, because it falls outside the rules. Even though it is below 3 Rand 82 a kilometer, the employee is receiving a fixed travel allowance as well. So the 52,200 reimbursement will go to code 3702. It's tax-free in the month, but you need to know that on assessment, that amount is going to be lumped into your travel allowance, and you need to get a deduction against that to prevent owing SARS money. Now, the other thing is on the reporting of this scenario, remember that the travel allowance is taxed 80%. So you'll see going into code 3701 is 8,000 Rand, 80% of 10,000. The fifth scenario, the employee is getting 3 Rand 82 a kilometer, which is the SARS rate, okay? And they're also getting a fixed travel allowance, okay? So same scenario, the employee is going to get a reimbursement of 76,400. That's going to go into code 3702, and 80% of his travel allowance is going to go into code 3701. The last one is the interesting one, because now you can see you've got a rate over the SARS rate, and you've also got a fixed travel allowance. So you know that because we're over the SARS rate, you're going to have code 3702 and code 3722 in play. 3702 is going to be the 20,000 kilometers times the SARS rate of 3 Rand 82 is 76,400. And code 3722 is going to be the excess. So basically 4 Rand 61 minus 3 Rand 82 times by 20,000, and that is 15,800. The important thing to look in this bottom example is that now the amount that goes into code 3701 is the sum of the 15,800 plus the 8,000 Rand that is taxed on the fixed travel allowance. Now, I know that's a lot to chew in one shot, but it'll just give you an idea of the implications. I always recommend that the company reimburse at the SARS rate. I also don't like the company reimbursing and giving fixed travel allowance. It gives the wrong message to the employee. I firmly believe that it's important for the company to look at the employee's needs and to give them a fixed travel allowance to meet those needs. As soon as you go over that SARS prescribed rate, you start to you start to factor in other issues into this equation that can be problematic, and it actually gives you less control of the tax situation. You do not know what's going to happen when that employee submits their tax return. Are they going to know that they have to submit a logbook? Are they going to have the right mileage? Is it going to come back and bite you? Okay, is your good deed of reimbursing more than the SARS rate going to come back and bite you? Because now the employee on assessment owes 10,000 Rand as an example. We see this every year, the employees coming back and saying, due to your reimbursement and travel policy, I owe 10,000. You know, it's always the company's fault. It's never their own fault. Okay. So be very, very careful. The rate in which you reimburse an employee has an impact on PAYE potentially, and that can decrease their take-home pay. So, summary: stick on the R3.82. Change it every year as per, or when SARS change it, and you're limiting the trauma that you or the payroll department are going to have. In terms of making a decision as to what you're going to do, it's important that you look at all the facts. And I've given you the tools to look at those facts and to quantify a good travel allowance for the employee. As I mentioned at the very beginning, don't get pressurized into doing what the employee wants. You're the employer, you know what you're talking about, you factor in a travel allowance that is best suited for that person. Very briefly, travel logbooks. It's interesting to note that the word logbook is not mentioned in the Income Tax Act at all. But if you're receiving a travel allowance or you requesting reimbursement from your employer, you're required to keep a logbook. SARS published the minimum guidelines for a logbook every year. And what's important to note is this logbook is becoming more and more strenuous to comply with every year. What I've done is I've included just a slide to show you what the minimum requirements of this logbook are. If you're not using the actual costs method to determine your deduction, you can exclude the last two columns. So you can see you need to have the date, opening and closing mileage, business kilometers. You have to say where you started, where you ended, and the reason for the travel. Now, in terms of opening and closing, it's not really required every single day to put the opening and closing. I see SARS have put that on their schedule though. If you want to keep things simple, maybe do that. I personally only keep my opening and closing on a monthly basis. Company car fringe benefits becoming less popular, obviously because of the costs of providing a vehicle. But once again, it's important that you have this in the employee's contract of employment, that they're required to travel as a condition of employment, and that they're going to be provided with a company car. It's also good to have a company car policy so that you can prevent abuse of such vehicle, and you're more than welcome to put limitations in terms of travel into that, so that the employee is not utilizing the company cars and Uber after hours, as an example. So what we're going to look at is we're going to look at the individual components that make up the calculation of the fringe benefit. And those variables are, first of all, the determined value of the car. Second of all, we will use a factor of 3.5% if the vehicle doesn't have a maintenance plan, or we'll use 3.25% if the vehicle has got a maintenance plan. And then we will, once we've done that calculation, we will either include 80% or 20% of that value into taxable income, this on the same basis that a travel allowance has. Okay, so legislation has changed. I'm not going to go through the variables that were applicable before March 2015, because most company cars are going to be newer than that. But what's important to note is the previous rules, the determined values had different ways of being arrived at. And SARS and people like the Payroll Authors Group and SATE and SAICA, as an example, all said that that value was unfair. So what happened is all the cars acquired after 1 March 2015, the determined value is calculated on the same basis. And that is the retail market value of the car. including VAT, but excluding finance charges and interest, okay? Irrespective of the business. Because previously, for example, car dealers could use the average value in stock, in terms of what's on their lot to calculate the fringe benefit, because a lot of car sales reps drive a different car every week or every day. So there was no scientific way other than using the average value to work out their fringe benefit. Now the legislation is very, very straightforward. The determined value is the actual retail market value, including VAT, excluding finance charges and interest. We've got one other element in terms of company cars, and those are leased, or cars that are on leases, operating leases, okay? And in that case, the value of the fringe benefit is the rental value on a monthly basis and the fuel cost to the employer. So you've only got those two scenarios now. Quite an interesting concept that is very, very badly applied. Once you've got this car, okay, let's use a scenario. You buy the car for the MD and things change. He uses it for a while. So let's look at the example. The car was purchased for 200,000 and it was used by the MD, say, for 30 months. Now the legislation says you can depreciate that vehicle before the next person takes it on for fringe benefit purposes. And the rules are very simple. You can depreciate that value on the reducing balance method by 15% for every 12 months completed. So you can see that I've mentioned 30 months. So you know that if 30 months has gone by, only 2 periods of 12 months has been completed. So you can depreciate this vehicle by 30%. But as I've said to you, it's on the reducing balance method. So if you look at that, the depreciation in year one is 30,000, which is 15%. And then in year two, you will depreciate another 15% on 170,000 because it's on the reducing balance. So the total depreciation allowed in this scenario is 55,500. So when the next employee comes to use the vehicle, the fringe benefit calculation on a monthly basis will be based on 144,500. That is the only scenario you're allowed to use. Okay. So just bear with me. Okay. Just to summarize there, the depreciation can only be calculated for 2 periods. So because we've only had 2 completed periods of 24 months, the remaining 6 months are disregarded. Okay, so once we've determined the determined value, we now have to say, does the vehicle have a maintenance plan? If it has got maintenance plan, we will take 3.25% of 144,500. And if it doesn't have a maintenance plan, we'll take 3.5% of 144,500. Now we have to apply either 80 or 20% to that value. As I said to you, if the employee is doing more than 80% business travel, then we will only tax 20%. And if they're doing less than 80% business travel, we'll apply 80%. When in doubt, apply 80% because SARS are going to ask you, have you applied your mind? The fringe benefit has to be on the pay slip every month, and obviously PAYE has to be deducted. And the 2 IP5 codes applicable for an employer-owned vehicle is code 3802, and if it's a leased vehicle, code 3816. Remember that if you've got a leased vehicle or a company-owned vehicle, you still have to keep a logbook, and you still have to put in mileage on assessment. As soon as you put that mileage on your tax return, the SARS system will redo the calculation and determine what refund you're going to get. And that's going to be based on what percentage your business mileage is to your total mileage. So if, for example, it's 50-50, you've been taxed on 80%. You should only have been taxed on 50%. So you're going to get a refund. Exceptions to the fringe benefit rule. Pool car. Quite a old trick. You acquire a vehicle and it's a pool car for SARS benefit, but only the MD uses it. Be careful. If you've got a pool car, you must have a pool car policy, and that vehicle must be able to be used by any authorized employee. Now, if you're going to buy a top of the range Merc as an example, SARS will not go for that being a pool car. I've seen it in practice when I worked at SARS. If private use is infrequent, there will be no fringe benefits. If the vehicle is taken home after hours, for example, if the employee is on call, then also the vehicle would not be regarded as a fringe benefit. Okay. Okay, then finally, we're going to just talk about subsistence allowances, another very abused process. Subsistence allowances are used to help finance an employee when they're on a business trip. And the legislation specifically mentions they must be required to be away for at least one night. So it talks about away overnight. But there's been a subsequent amendment as of 1 March 21 for incidental costs, and we'll go through that now. So effectively, SARS allows for 2 subsistence rates. They allow for 139 Rand per night for incidental costs. Those are things like tipping, parking, maybe an Uber, the type of expense that you might not get a slip for. And then they allow 452 Rand per night for meals and incidentals. Now, in both cases, it's normally a given that the employer is going to pay for the accommodation in addition to this. So accommodation is not factored into this. As of 1 March 2021, SARS have factored in this incidental allowance of 139 Rand. So what that means is if the employee is away during the day, for example, he takes a day trip to Mooi River, he's not going to be away overnight, the employer can give that employee 139 Rand to cover incidental costs and maybe some food while he's on the road. There's no requirement to supply any reporting documentation because it's at the SARS rate. We've also got scenarios where the employee travels outside South Africa. There's a set of tables that are available on the SARS website, or you can get it from me if you want. And that has a per country deemed rate. And that is in various currencies. So for example, if I'm going to travel to Nigeria, Nigeria will probably have a dollar rate. You can give your employee that dollar rate to cover expenses while they're out of the country, tax-free. The scenario changes, though, if you go over the SARS rate, and I'll discuss that shortly. So what I've done in this next slide, I've factored in a couple of examples of clauses that we frequently see on employment contracts. And the first one is clear that you're required to spend nights away from home for business purposes. The company will pay your accommodation. Okay. And it's always good to have a value, because otherwise the employee is going to book themselves into the Hilton hotel when there might be cheaper options available. And the company will pay for meals while you're away from home. You also might, as a company policy, want to limit that value. The clause would say, in addition, all receipts from any incidental expenses need to be submitted to the company, and you would set up a process of reimbursing. Quite a common method. So you effectively allow the employee to go, spend money within limits, bring the slips back. It's looked at by management, authorized, and reimbursed to you. Nothing wrong with that, provided obviously the employee hasn't expended money on private expenses and being reimbursed by the company. Second scenario, the same situation. You're required to be away from home on business purposes. The company will pay the accommodation expense, but the company doesn't want the drama of dealing with reimbursements. So the company can give you 452 Rand per day for meals and incidentals, or 139 Rand per day for incidentals, tax-free. All that you do is you report that on the IP5. The employee is required to travel within a month of receiving the money, and SARS are happy. You've used their rates. There's no slips are needed. Okay. So the tax treatment of those two scenarios, as I briefly mentioned, the employee would retain slips, hand them in. There's no PAYE implications because they are expenses legitimately incurred. And then in scenario 2, where you've chosen to go the subsistence allowance route, you've gone at the rate that SARS allow, and there's no PAYE and there's no PAYE on assessment. If you go with a rate higher than SARS rate, it's important that you code that correctly in payroll, and that the employee knows that the slips that they've maintained to prove these higher expenses are available to SARS. Otherwise, the difference is taxed on assessment. So then, once again, you're faced with a dilemma. Do you want to go the higher rate, or do you want to go the SARS rate? I suggest SARS rates, because then you do not have any reporting requirements other than on the RP5, and they're tax-free. If they go above the SARS rate, the employee is going to get themselves tied up on assessment, because they're probably not going to have kept the slips. So what I've done is I've just included the IP5 codes for you. Code 3704 is used if you exceed the SARS rates of 452. And then code 3714 is used if you do not exceed the rates. And as you can see, you've also got international rates. It's generally just 50 added onto the South African code. And then as a parting shot, I've just included some rules. It's important that a subsistence allowance is not included as part of an employee's package. So if you're going to pay the employee 40 grand a month as a remuneration package, you can't factor in 5,000 Rand as a subsistence allowance. SARS see that as blatant salary structuring to avoid tax. Subsistence allowance has to be paid in addition to the employee's package in the month that they're required to travel. So don't fall foul of that, because you will have auditors on your back. So yeah, briefly, fixed subsistence allowance cannot be paid to an employee who's required to relocate. If an employee is required to relocate, pay them the reimbursement of relocation expenses. Do not give them a fixed subsistence allowance to move from Joburg to Durban. SARS are not going to fall for that, and you're going to get into trouble. Just one more parting shot. You might have seen in the paper, SARS are recruiting specialists in various areas, not only audit areas, but in systems, processes. Quite scary. I've got some ex-colleagues who've been talking to me about this. SARS are working smart now. They're pulling information from all areas to be able to effectively see what's going on, what employers are paying, and what employees are getting. So if there's ever a time to comply, it's now. Do not take chances. My policy when I was at SARS were you know, in the first day, I knew how long I was going to be there. You know, in the first day, if things were all over the place and policies were dodgy, I knew I was going to be there 3 weeks. If in the first day, everything I wanted was given to me, there were policies and procedures and they were applied, I knew the place was probably going to be a 1 week job. So do not have SARS there for 3 weeks. And as I said, you might not have them there for 3 weeks. You might have them there for 3 months doing a virtual audit. So just be careful. They're on the warpath. They try to collect money. And if you're a big company, you're probably going to be targeted. We've found that SARS are more interested in the big companies because generally the mistakes lead to bigger monies. I hope that's been of interest to you. I hope you've learned something. If you want the slides or a recording, please just send it through a note to Priyanka, and we'll send it out to you. And yeah, please log on to our future webinars. Go to our websites, look at our YouTube videos. You know, it's all out there to give you as much information as possible so that you can make good decisions. And then obviously, if you want any consulting advice, any help from us, whether it be from a legislation or from a HR policy perspective, yeah, please let us know. And thanks again for joining us. It's been wonderful to share with you. Have a good day. Questions? Okay. Sorry, we have got a question. Okay, repeats the handling of the petrol card. If you receive a 10,000 Rand travel allowance and a petrol card reimbursement on a monthly basis, so let's just say the fixed travel is 10 and petrol's 5, you'll be taxed in that month on 15,000. You'll know that 15,000 is going to go to the fixed travel allowance code 3701. What most employers do is they run a month in arrears because you only get your statements late in the month. So as long as that 1 month in arrears, you're including the petrol bill for that employee, and we're talking travel allowance now, in code 3701, you are compliant. Is there a difference between a car allowance and travel allowance? No, it's exactly the same thing. It's taxed exact. It's just a different name for the same thing. And what happens when the vehicle is fully depreciated? Okay, so if the vehicle is passed around so much, it would have no value, I suppose. I'm not actually quite sure. What I'll do is I'll look into that one. I don't think SARS have ever looked at a scenario of the vehicle staying in a company long enough that it changed employees so many times. But remember that it's only going to be depreciated if it changes employees. It's not going to be depreciated based on the number of years that the person has used it. Unfortunately, you know, if you've got a car with 500,000 and the MD uses it for 10 years, it's all every month the determined value fringe benefit tax is going to be worked on 500,000. It's only if he palms it off on someone else after a while that the 15% per completed 12 months is applied. But I'll get back to you on that other one. Okay, that's all. If you shy and you want to ask any other questions, you're welcome to fire them off to us and I'll come back to you as soon as I can. Sorry, one more before I go. If you are getting taxed on a fringe benefit on a company card and have a company petrol card, will you get taxed? No. So, okay, the company car is completely different to the travel allowance. With the company car, the logic is the employer is paying for all the expenses. So the employer would be required to pay for the monthly installments, the petrol, the maintenance, the insurance. The employee just pays the fringe benefit tax. The petrol card only comes into play when you've got a travel allowance. Okay, guys, that's it. I promise you that's the end of it. Have a lovely day and have a lovely long weekend. Cheers. Bye.